All right. Comment from Sam. Looks like Chat GPT is not an instant hit for Microsoft. Uh, it's not going to be an instant. I mean, I had my own concerns on something that becomes so popular so soon. But Microsoft, I mean, they're gonna use it for their integrating into Bing's and also into a lot of their Office applications. But the journey is gonna be a little tougher than what everyone else thinks.
Vivek.
Yeah.
I was looking for there was a song in the 80s that said I'm turning Japanese, I really want to change so, but Google was too politically correct.
Yes.
To find that song. But then I couldn't Bing is not easy to use.
Yeah. I mean, that's true. Bing is not easy to use. That is why, I mean, Google owns more than 80% of the share in the search market. But the question around the whole Chat GPT is that it may make search irrelevant. Why do I need to go and go through the 10 articles if I can get the gist of those 10 articles presented to me in a very nice, concise manner, which is usable immediately. So, but again, there is a lot of hype around the Chat GPT, and not that Google doesn't have the technology, but as we spoke about, I think maybe 2 weeks ago or in a previous one, there are a lot of legal implications and ethical implications around the current beta version, which is there on the Chat GPT 3, right? How are you compensating those creators of the content? All the content that the Chat GPT 3 has used is the Chat GPT 3 has learned from all the content generated by other content owners, right? The way things like DALL-E could generate those images if you give a text is because it has learned by looking at millions and tens of millions, hundreds of millions of images which have been generated by other content creators. But they don't get compensated. Similarly, if you ask a question to ChatGPT 3, it can give you an answer because it had run through those articles, those news clippings, those books, and the billions of pages about that topic. But the compensation doesn't go to those original content creators who wrote that content, right? So it'll be a few years before the whole legal implication is taken care of, but it has shown the potential, which is very, very exciting. So and that is why I think Google came up with a state. I think they did create a state. I'm not sure did they officially send out a statement, or I remember reading somewhere the reasons why Google is not gonna do or not gonna release its own version of ChatGPT 3. There are company like a Google will have much bigger I would say much bigger risk in getting into these legal implications than, let's say, OpenAI company has. But anyway, I'm excited. Something new from a tech perspective, something new after a few decades. All right. So what do I have for today? Today, I would say 3 main topics. I want to go through, do a little deep dive on ServiceNow. I think we talked about this company way back in 2020 and didn't touch this company since then. So I do want to go back and look at it, because now I'm looking to add 1 or 2 tickers to my portfolio. As you know, whole 2022, I was focused on reducing the numbers of tickers that I have in my portfolio, which is now at a decent stage. Now I'm looking at if I can find some good companies to add to my portfolio. ServiceNow is one of that company which is on the list. I do want to do a little deeper dive into ServiceNow. It's business.
Hello, everybody. What's going on, guys?
There we go. The day I don't enable a security.
Why'd you mute me?
Someone.
Hey! You! Why? Stop muting me! You little bitch! Hey!
All right. The day I don't enable waiting room, we'll have someone who's probably frustrated with life coming and jumping on it. All right. Let me see. Okay.
Vivek, can I call you Asian?
All right.
No, can I call you Asian? Then I could tweet that I'm getting anti-Asian harassment. You are. Are you Asian?
Ethically, yes.
Okay. Well,
Ethnicity. I'm a South Asian. Otherwise, I'm American. Cool. All right. Okay. I'll have to keep an eye on the folks who are joining on the waiting room and admit them. And this happens. It's not the first time. And for me, I think it's the second time, but I've been into some other meetings where we have seen this happening. It's okay. Yeah. So I do want to get into ServiceNow. Other thing which caught my eye is around whole 0-day expiration options. There's a lot of stats which really got me interested to understand what these 0-day expiration options are. And if you are really interested into it, what are the things that you may want to or I'm gonna put folks on mute. Okay, so for now, I've put everyone on mute. So if you really want to unmute and talk, just raise your hand and then we'll get it going. Yeah, a lot of background noise and all the stuff. Okay. One second. Or just give me a moment. Okay, one sec. All right. Yeah, that's fine. Okay, let me go back and enable some of the security. Cool. No, I mean, let people come and join. That's okay. All right. Okay. Cool. So guys, for now, at least for today's meeting, let's focus on not gonna enable. I just turned off the video and all the 1 second. Who's calling? Can't take the call. No, let's continue. Okay. So those are the two main topics. Third one I want to look at is I went through Howard Marks, who is a very famed, renowned investor / money manager, founder of Oaktree Capital. The Howard Marks memos are very well respected. So I do want to talk a little bit about something that I read from Howard Marks memo. Okay. So these are the three main topics, and let's get going. And other thing which I noticed when I logged into Zoom is there's some new feature on Zoom which says Zoom apps. Has anyone used those? It says on my account there are some apps which Zoom is showing me. Says I can use it maybe for free for some days. I don't know. I never tried, but something new that that I found the moment I logged into Zoom. Cool. All right, so let's get going. We'll talk about macro later. We'll cover the rest of the stuff, and then we'll get back to macro. Okay, so let's look at some charts, tweets, news that caught my eye. This was an interesting one: bonds versus stocks. Bonds considered as a safe investment. 2022, we all know, very bad year for stocks. I also knew that it was a bad year for bonds, but what I didn't know was how bad was it. So for bonds, it was like the worst year since 1989 for bonds. Have been like 2%, 3% down, right? But in 2022, it was on 13%, which is kind of unheard of, that if you're holding bonds, your portfolio could go down 13%. That's a kind of an epic loss for bonds. I knew bonds were down, but I didn't know till now, until I saw this, that how big a loss it was for the bonds market. Stock market, yeah, it loses 30%, 38%, the 20%. After once in 3 years, market is expected to lose around 10%. Once in every 5 years, 25% drawdown is common. But when you look for the bonds, that was an epic loss. Other thing that caught my eye was around the tech layoffs. Myself being in this sector, yeah, I mean, this is something that hits very closer to our home. Latest news is Google to lay off 12,000 people. And mega tech are now doing mega layoffs. The numbers are not in tens or hundreds. Most of the numbers are in thousands, right? 12,000, 18,000 people. So, okay, I'm looking at some comment. I think Mer says, I don't call him dumb. People do it for fun. I think, yeah. I mean, there is no harm in it, as long as there is no offensive content, etc. I just want to be, take care of the sensibilities for everyone. That is why, yeah, people would like to have fun. Some people want to get attention through being a Zoom member. That's fine. These things happen, and nothing to get worried about. So this week, I think was it Wednesday or somewhere, when Google announced another, they're going to lay off around 12,000 people. And this comes after a long list of a lot of other companies, especially in the tech sector, cutting down on workforces. I would say they are now right-sizing the companies, their own companies. They are now going back, negating the lot of hiring that was done in last 3 years, I would say. Amazon had doubled their workforce since 2019. Same is the case with Meta. Google didn't exactly double it, but they also increased their workforce by a lot. So I just took a screenshot from layoffs.fyi, looking at the top 20 in terms of layoffs announced. I think if I combine both the layoffs done in 2022 and announced in 2023, Amazon takes a top slot with overall 18,000 employees. Next comes Google with 12,000. And then, Microsoft is 10,000, Salesforce is 8,000, so on and so forth. Google, I think overall had around 180K people. So 10,000 it's a huge number, but from a company's overall percent perspective, it's only a 6%. Probably they have a lot more employees than what I thought. So it's a overall, it's a 6% cut down in an employee base. And again, I think every company right now is looking to cut cost. And if by just announcing this layoff, you can get 3% jump in your stock price, why not? So we've seen this with every company. When Meta announced the layoffs, stock went high. Amazon announced, stock went high. And now when Google announced, stock was up like 3% on that day. But bad for the people working in tech sector, but there are a lot of other jobs in other sectors. So if you're versatile, don't mind moving into different sector. You're not married to tech. Unemployment situation is still pretty good, for pretty tight. Labor market is still pretty tight. We saw it in the last week when we reviewed the JOLTS report, right? 3.5% unemployment rate. So, but yeah, hitting closer to home, San Francisco, Bay Area, Seattle, bad situation from when it comes to the tech side of the house. But the positive side of that could be, and I saw the tweet from Jason Calacanis, who's was early investor in Uber, plus a lot of other startup companies, runs his own syndicate as well, part of that syndicate. 10,000 laid off Googlers could be 3,000 new startups with 3 founders each. I couldn't agree more, especially when these big tech companies have been hiring. The way these big tech companies have hired for past many years was just to starve off any of the other startups from getting the good talent. And it was easy for them to hire because the cost of hiring was almost zero. Cost of capital was zero. You could raise capital at almost 0% and then hire a lot of people so that those people don't go to startups and build competitive products. Now, there's a lot more talent available to a lot of other companies, including startups. So one good thing that could come out from this is we could see a lot more innovation in our industry because now this is a talent which is available for a lot of other companies as well. I see a comment, Sam said, does it matter? It's under 10%. Yeah, I mean, headline number 10K is a big number. 12,000 is a big number. From does it really matter in terms of for Google? I think it does. I heard number of layoffs, most just churn within the organization. So there is a separate term for this one. So we have heard term called quiet quitting, in which employees just don't perform up to their level, up to their, the full potential. It's typically called, hey, I'm just working my paycheck. Right? That's quiet quitting. We have also seen, I don't know what's the right term for it, which is around where employees have more than one jobs. But nowadays, I don't think it's an official term yet, but this term is also being floated around, is quiet hiring. So employees were doing quiet quitting. Now employers are now doing quiet hiring. Now the reason they are doing quiet hiring, moonlighting, but the reason is the way employers are doing quiet hiring, and the quiet hiring means is they are not going out and getting a new talent, but either they are retraining the existing people or adding additional responsibilities to additional employees for the people, for the new talent or for any new requirements that they have. So now many of the employers are resorting to quiet hiring. So they are hiring a new talent, they are hiring new expertise, but like Sam said, it is just either within their organization itself, or it is they are just getting it through some other contractors, but not really hiring employees. So quiet hiring is now happening in Bay Area. Jack Welch says get rid of bottom 10%. Yeah, Jack Welch had its own days. I think he was in his peak. He was one of the most respected Americans, most respected CEO in the world. I mean, while I was growing up and studying in India, I admired GE. I think I read a couple of books from Jack Welch, but things have changed. Management practices have changed over the years. And I think now, if you look at it, some people go back and question some of those practices that were promoted by Jack Welch. And again, I think after every few decades, the management strategies would change. We have seen that even on the way companies operate, right? There is a lot of focus on being a conglomerate, controlling the whole value chain for your products, and then switch it back to, oh no, let's focus on core competency. And now we probably are going back to looking at controlling our full value chain after COVID. So I think 30, 40 years, the strategies come full circle. Same is the case on the tech side. There were days, maybe 30 or 40 years ago, wherein you would rent computer time on big mainframe servers and log into those servers through a dumb terminal, right? If you go and read Bill Gates' history, that's what he did in his school. They would log into and they were fortunate enough, Bill Gates was fortunate enough that his school actually had access to a computer. But you log into a computer, you don't have your own computer. All you have is a dumb screen, which will allow you to log into the computer, which is hosted somewhere else. From that, in 1960s, we moved towards having a personal computer at every desk. Now we are moving back to, I don't really need a big computer at my place because everything is now available on cloud, which is almost similar to what used to happen 40 years ago. Someone is hosting a mainframe. Now Amazon is hosting all the computing capabilities. I just need to have a, lower down, thin down version, a terminal, which I can just access all the services over cloud. So it's seen that it's gone back into, the full circle with, of course, with a change in technology. So yeah, same is the case with the management practices. Every kind of a management practice, they have their own seasons. 3270 to log into computer. Not sure what you mean by this. Maybe in 3270, people would think about, do I even need to log into a computer? Possible. We probably be living inside. If Meta has to be believed, we might be living inside a metaverse. There is no need to log into a computer. We are inside the computer. I don't know if your comment was in reference to that. But yeah, those dystopian scenario of being in Matrix. Okay, so now the question after we have seen Amazon, like all the big tech firms, Amazon, Microsoft, Google, Salesforce. Now question that Street is now asking is when Apple has not announced any layoffs, but I was yesterday evening, I was volunteering my time for an organization which was doing something for homeless. So we were, again, the discussion started over there around, jokingly started saying, hey, let's develop some other skills because the market in the tech sector is really tough. So we went there for packaging food and all that stuff. And then someone started, yeah, that's why I'm here to learn the new art, get into something different. There I heard someone who's an Apple employee was actually telling Apple has become very strict in terms of having people come to office. They track in each and every hour where you're logging in from, and if and you have to be in office for a particular number of days, and if you miss that out for a month, you actually get an email sent out to you and to your boss, etc. So they were telling Apple is becoming very strict in terms of monitoring what people are doing, how productive people are. And I don't know, maybe they'll use this as an excuse to announce layoff like a lot of other tech companies have done, because they are under pressure. Apple is under pressure right now because come what may, I mean, I don't know how productive Apple employees are or how effective they are from with the current workforce. But the question, if you're not on a tech side, if you're on the Wall Street side, question that everyone is asking, because all the big companies have laid off people, becoming lean, mean, thin. When are you going to do it? We don't believe that you don't have any extra flab. Right? So that's a question right now everyone is asking. And I wouldn't be surprised if Apple come and announce some sort of a layoff. To credit to Apple, they didn't hire that much during the pandemic or during COVID. Right? But who cares? Wall Street has a short-term memory. Right now, they're looking at when every other big tech companies, they are firing people, cutting down on the cost, which also give a boost to their shares. And Apple, why are you not doing? Okay. So the day, I would say the layoff days are not over yet. 2022 was bad itself. But what we have seen in first 3 weeks of 2023, that's even worse than what we saw in 2022. So still got to be careful. I don't think the damage has been done yet. And even if the companies really are not in a crunch, they could still use this as an excuse for cutting down the cost. Ramesh says, can you phone with a link? Someone is having a problem. Okay. If you need a link, there's a link. Yeah, but the link will be there on the meetup anyway. All right. Other thing that caught my eye, and this is what we were talking earlier. I think we spoke last week also around why Google doesn't want to go all into this whole chat GPT kind of a thing. And now this week, we also saw the Getty Images now suing creators of AI art tool called Stable Diffusion for scraping its content. Stable Diffusion is one company, and Stable Diffusion is a product in which it is similar to DALL-E. DALL-E is we reviewed DALL-E in December when it was released to the public, but the concept is similar. You give it a textual information, and it will generate an image based on the text. But same thing, the way and how it learned, it was using a lot of those stock images to train its model. So now the Getty's Shutterstock is there, Getty's is there, which have a lot of stock images available. And also there are proprietary images available. But Stability AI is a company which has created a product called Stable Diffusion. They used all those stock images to train their models. I think so if it is available on web, you could use it, but you cannot then sell it for commercial purposes. You can use it for a personal uses. Again, there's a lot of illegal implications that need to be sorted out, but this is the first one to come out of a door in which now Getty Images is suing Stability AI on that you use our content and you're making money out of that content, but we are not getting anything. And hence, those who have contributed to Getty, they are not getting anything. So there's now, lawyers will figure out IPs and all that stuff, but these are the cases in which I think the AI growth, the usage of AI and all these, the growth in AI will be, the commercial usage will be limited by, until we get all the clarity around the IPs and the legal stuff. So now when it comes to the Google is able to scrape all that information and get around with this, is because they'll give you the link for you to go to that page, right? When you go to the ChatGPT 3, or you go to Delhi, or you go to Stable Diffusion, you will see the product, you will see the answers, but there are no citations, no links of from where those content has been sourced, how they learned it, and hence I think that's why there are concerns around whole IPs. So we'll see where this battle ends. But like I said, the tech is great. Good to see some new tech challenging the incumbents. And Microsoft, they want to be king. They want to be a big player. They had already invested in OpenAI, I think $1 billion. They already had that. And if we're to believe what the news in the market, they are in talks to invest $10 billion in OpenAI. Of course, there is concern around that. A lot of them will be through the credits that they will get on, the OpenAI will get on Azure. So OpenAI uses Azure cloud services to run their whole system. And it costs them almost $1 billion per year for their cloud services. But anyway, so Microsoft had announced that they want to integrate the OpenAI technology, ChatGPT 3 technology, into Bing search. They had also announced that they're gonna provide the AI services, AI tools on Azure, and those will be powered by OpenAI. And thirdly is they're gonna integrate all this technology into their other products which they have. And Microsoft has got a deep roots into Office products, into the commercial and the business segments. And they could enhance the quality of those products. I mean, if you're using let's say Microsoft Word and you're typing something, it does suggest you the next word, right? That could be enhanced by a lot by integrating OpenAI stuff, right? I want to write a memo, right? Or let's say, or if I want to create a syllabus, right? I'm starting on my Word document. It could actually suggest me, a few templates. It could suggest me some content which I can then pick up and refine. The potential is immense. I mean, if you are active on Twitter or on LinkedIn, right? Every day I'll come across 3 or 4 posts which will talk about how some folks are using ChatGPT 3 to be a lot more productive, to generate a lot more ideas, to have software do a lot of stuff that they were prior they had to spend a lot of time on. So I do see there's an immense potential. Just have to see how Microsoft packages everything. So there are a few more things. They're gonna it's not just Microsoft. I think there are a few other things like Jasper is integrating GPT-3 to create products that can automatically generate text for the websites. There are other companies like Udly used for speech coaching. So in fact, Microsoft want to rebrand itself as a front leader on the AI side. They lost the search game to Google. They lost the mobile game to Apple, but they want to now focus and try to be a leader on the AI side of the house. So we'll see how it goes. But right now, Microsoft is in much better position financially to do it. $10 billion is nothing. They got $100 billion on their balance sheet. What does Asif says? Meta and Twitter owns so much user data, signals, picture, blah, blah, would be huge for training these models. Google at a huge loss here. So Google also has like I said, of course, Google is threatened by this, because if you can get the right answer, why would you search, right? But I think I do see a lot of potential around the Meta, because of the content that they have, which can be used to train these models, right? But I'm not writing off Google yet. They also have a big capability in AI side. I mean, Google owns DeepMind, and I wouldn't be surprised if they come. Of course, they may not release the product like ChatGPT 3 because of some of the other things that we talked about, legal implications, but they could still, use it on their other services. But anything that challenges search will be detrimental to Google. If we completely stop doing search, then that's where Google makes all his money, almost all of its money. That would be detrimental. But I think we still jury is still out there. I'm hard pressed to think that the Google, with all the talent and all the money that they have, they can't do what OpenAI has done. I doubt it. I think it's just a question of focus, or whether they want to, when and how much do they want to do. I see another comment. It's being used in college for homework, so professors are asking for handwritten. Yeah, I mean, even for handwritten, students will just copy it. But the other way, I think I saw, was it a Wharton professor or a Princeton? One of the professors, they have updated their policy around usage of these AI technologies. And there was a tweet that professor has tweeted. It says, basically, it was a call for every teacher to embrace these advancements that's happening in technology and upgrade themselves. You can't get rid of it, but then how do you make sure you're still able to? You basically have to change your method of either teaching or grading or seeking answers, so that even if these things are available, you can still find out when you have to rank students and all that stuff, who's good, whatever grades and all that stuff. So it was good to see that professor actually going ahead, and he updated his policy around how and what students can do with AI during the homeworks. Yeah. Rest says more hands-on assignments. I mean, on the other hand, I saw some school district actually banning OpenAI from school networks. It's similar to 30 years ago. I mean, you could have banned internet as well. Probably the similar concerns would have been during internet. During my time when I was going, we had to go to library. Flip through those library cards to figure out which book you want to go and pick up. Then you go to the shelf and pick up the book, and then read the book if you want to do anything extra, and then use those for your homework, right? When internet came along, whoa, things became much easier, right? And I'm sure maybe during that time, teachers would have had the same concerns around, did the student did his own, hand and leg work to get to this answer, or did they just went to some website? But now Nobody questions if you go and get your learning from websites. I guess similarly, a few years we'll figure it out how to live with this AI. But whenever a new tech, disruptive tech comes, we always have some concerns. Right? Going back to early 1920s, I'm sure there were concerns around how can we protect horses and save the jobs for horsemen, because the cars are out there. There would have been legislation. I'm not saying, I don't know, but I guess some of the cities, some of the counties would have moved ahead with some legislations to ban cars. Right? Every disruptive technology will go through this. So AI is nothing new. All right, other thing that caught my eye was around Alibaba. What's happening on Alibaba? The share has been doing good, but I didn't know about Mr. Ryan Cohen's engagement with Alibaba. So for those who don't know, Ryan Cohen, he earned his badges by, he was a co-founder of a pet retailer called Chewy. And Chewy was a rage during pandemic. It's still a good company. I think they're still doing good. But of course, when I look at Chewy's sale price, what's CHWY? CHWY. Over last 1 year, they've been okay. Now there we hit pandemic. This is pandemic top, which is almost $120. Now it's back to $41. But started with Chewy, then got into GameStop. He was, I would say, God Messiah for all those Reddit investors who were piling upon GameStop. And when he took positions on GameStop, everyone thought he's going to turn around GameStop because it comes with a good e-commerce experience with Chewy. Nothing of that sort of happened. He also made some money. He also used that as an opportunity and used Reddit crowd to make his own money. Now he bought a few $100 million worth of stock in Alibaba. Not that it's going to move any needle, but it was in the news because now we see an investor who's loved by meme crowd is now becoming active on Alibaba. I won't call him still as an activist move because the stake is so low. Alibaba is how much right now? And it keeps changing on every day basis. But if you look at Baba, it's a market cap, it's $300 billion company. Right, a few $100 million won't make any difference. But what he's suggesting Alibaba is to do a lot more share buybacks. So Alibaba already have a plan to, they already increased their buyback from $15 billion to $40 billion. Ryan is asking or suggesting them to boost it by additional almost $30 billion. So again, in his logic is see what Apple has done. The share repurchases have done for Apple shares. But what we don't know, we know, but that any company in China, you know who the big boss there is, right? So yeah, it's a little more this is more of a fun news. I don't think it's going to make any difference to Alibaba shares, whatever, whether it's Ryan Cohen, whether it is a Carl Icahn who invest or take some stake in Alibaba. But Alibaba shares has been doing great. It's up year to date almost 30%. And it has nothing to do with Ryan Cohen's stake in it, but all the the China reopening story. So one of a better performing stock in the portfolio. Chinese market, I think at least since the start of this year, overall Chinese market has been up. Let's look at the large cap ETF of China, which is FXI. Oh, let me do year to date. And let's see percent wise. Oh, year to date, it's 10% from, okay, it's 10% FXI large cap. Let's look at the one ETF which is focused on internet. It's also 10%. Started from a year. Baba is up 20%. Let's see where's JD.com. JD.com surprisingly is down. Pinduoduo, 9%. Yeah. But overall, I think Chinese market, if ignore the last year to date, we're looking at from, this is what, November, start of November. It's almost not PDD, FXI, Chinese market. It made it slow in November, and since that low, it's up from $20 to $32, up 30% in 2 months. Right? Probably the best performing stock market among the few that we follow. I'm sure there are other stock markets that have done better, Turkey, etc. Yeah, I still hold Baba in my portfolio. I mean, it's a really, really long-term position. But be careful when you're investing anything around the Chinese companies. You are in bed with CCP. And if you're not comfortable with CCP as your partner, you have no business to be in Chinese stocks. All right. Okay, other thing, I mean, this is, any other comments on the Chinese stocks? Anyone else use Chinese stocks? I see a comment from John. It was Keith Gill, the messiah of WSB for GME. Yes, Keith Gill was the one, Roaring Kitty. He was the one who started focusing on GME as a, he actually did a good analysis of GME, real fundamental analysis of GME, looked at the short positions and said, why is buying it? It started the whole drive. But I think this guy, Ryan Cohen, he also bought a stake in GME, which gave a lot more legitimacy to GME as a company. He wasn't the one who started, but he piled up on it. Let me put it that way. Yeah, Roaring Kitty was the one who went on to YouTube, and he was also calling for a congressional testimony. And that was, along with all the other tech CEOs, we had Robinhood CEO, Vlad. There was a Citadel CEO, Ken Griffin. There was one more CEO, I forgot. And then there was Roaring Kitty. It was very refreshing to see an individual investor, what the difference it made that even he was called in for testimony in front of Congress. John said, I think Michael Burry already had some stake in it, and Keith Gill started talking about it. Not sure. Yes, Michael Burry started building some stake in 2019. And I don't know, should I curse myself? I was actually listening to a podcast in 2019. At that point of a time, someone had presented a bullish thesis around GME, and the GME was like $2 or $6, some point of it. And I was like, I don't know if I should buy that. But again, that thesis was that Michael Burry was building his position. But in any case, yes, Michael took some positions. Roaring Kitty went on to Reddit and then Ryan Cohen. And Ryan Cohen is not just, let's say, I call him a meme messiah because not just GME, he also took a stake in Bed Bath and Beyond, right? So these are some of the stocks that are loved by meme crowds. All right, any other comment? Yeah, no one can boss around CCP, that is true. Okay, other thing that caught my eye was around, this is a little bit related to crypto side also is, but it's a general, I do want to talk about it, the amount of hubris that some of the founders have, and I'm sure they can still get money because VCs are always hungry, and VCs won't care about anything about it's right or wrong as long as they can make money. So what are we talking about here? If you recall, way back in 2020 May June timeframe, the biggest crypto hedge fund called Three Arrows Capital, it blew up because Luna blew up, and then those are the repercussions of Three Arrows Capital blowing up. We are still facing it, right? FTX is also, if you go and dig into dig deeper into what had happened to FTX, why FTX exchange collapsed, because of things that they done shady deals with Alameda, and then Alameda went down. Why Alameda went down? Because they had loaned capital to Three Arrows capital to Three Arrows Capital, pun intended. And not today, was it Friday or Thursday? We saw another big company, Genesis Trading, filed for bankruptcy. Again, go 2-3 levels down, you'll figure out some threads tied to Three Arrows Capital bankruptcy. So we are still reeling. The whole crypto economy is still, feeling the impact of the bankruptcy of Three Arrows Capital. And there were two founders, Su Zhu and Kyle Davis were two founders. These guys were traders with some hedge fund and some Wall Street fund, and then they started Three Arrows Capital. Now, we heard a news that these founders are in the market to raise $25 million to create a new exchange which will allow which will allow speculators to trade claims into on the companies that are going bankrupt. And I was like, what? What a hubris. And they have a chutzpah to do that. And probably they will get capital also. And on top of it, what they're saying that the Three Arrow Capital creditors, they owe money to those creditors. It is still going through the whole bankruptcy stuff. They say, we can convert your claim into equity in this new claim trading company. I find it convoluted at so many levels. But yeah, these are the things that happen. And probably they might still raise money, and they'll probably find some VCs who will be willing to bet on them again. Because if you really look at it, Three Arrows Capital declared bankruptcy, Celsius declared bankruptcy, Voyager declared bankruptcy, BlockFi declared bankruptcy, FTX, and now Genesis. And these are the big ones. There are probably a lot of smaller ones that have declared bankruptcies. So there are a lot of claims that creditors have on these bankrupt companies. But there is no trade, there is no, again, I never looked into this site, but I guess probably there is, or people don't know, there's no easy way to trade those claims. If I'm a creditor to, let's say, FTX, I have $100 million that FTX owe me. Can I find a market where I can sell my claim to someone else? Maybe 25 cents on a dollar? 10 cents on a dollar, 30 cents on a dollar, and at least I'll get my 30 million and let the other person fight through the bankruptcy. This is what these Suzu and Kyle Davis, that's an exchange they want to build, is on which you can actually trade the claims. Oh, but these things will happen, and probably they will get some money. And on top of it, they want to name the exchange as GTX. I mean, you're just one after another. It's like poking fun at what's been has happened on the crypto side, plus also their own company, right? And they're the guts to come back and say, okay, you can get an equity in my company instead of the claims that you have on us. All right, I thought I'll share a few things, but this was another one which I was reading today morning around a lot of stuff that happens on the private equity side and how that's just an eyewash, right? You got to be really careful if you have a private investment and your VC is coming and telling you, oh, we are doing good, right? There's a reason why VCs are reluctant to mark their investments down, and why we still see private valuations still at a higher, whereas the public valuation has been cut into half. Maybe some other day I can share it, but it's a beautiful article from Matt Levine around the whole private sector, private companies valuation, and why how if you are looking or reading through the headlines of startup, this startup have raised money at almost the same valuation as of last year, you need to dig deeper into it to find out what else are they given, because VCs they don't want to take a down round, so they'll give a lot of a backdoor entry to the newer investors, giving them something else, but not take a headline down round of investing. Yeah, so pretty interesting to see all these financial shenanigans that happen when it comes to Wall Street, whether it's a private or public. John says, grifters gonna grift. That's true. And I mean, greed exists, and that allows them to grift again and again. On Friday, was it Friday? FTX new CEO came back and said, hey, I think we can make FTX work again. So they may reopen the FTX exchange for business. Anyway, enough about these grifts in crypto side. Let's get back to the stock side. So like I mentioned at the start, last weekend, I went through the Howard Marks memo. If you have not read his memos earlier, I would recommend do that, because these memos are very well respected and famous in the investing community of what Howard has to say about investing, right? So the latest one talks about sea changes, and he's been in this investing industry for 45-50 years, so he has seen a few things here and there on when it comes to investing. So I have the link to the latest one. I can put it here if you really want to go and look into the memos are generally longer, so it will take you takes around 45 minutes to an hour to go through it. But here's a quick summary. Howard talks about that in his own whole investing life, as a professional investor, he has seen two big sea changes, and then he talks about the third one that's coming. I do want to share a little bit about that. The first sea change that he talked about happened in late 1970s when the high yield bonds surfaced and became an acceptable instrument of investment in the investor community. So prior to that, when it comes to investment, the choices were pretty limited. When I say limited, means you only invest in big companies, Nifty 50s. You only invest in very stable companies. Invest only in bonds. Those are those AAA rated bonds and all that stuff. But in 1970s, I think I forgot the name of which company. There's one, Milken, Mr. Milken. He created those high yield bonds, and then this community started to accept it. Those high yield bonds also gave birth to private equity firms. Right? The article goes into details of why, but the first sea change was not the invention of high yield bonds or private equity, but was an adoption of a new investor mentality. Prior to this, the investor mentality was to avoid risk, and that's why invest only in Nifty 50s, invest only in government bonds. Prior to that, that was the investing philosophy. Afterwards, the risk wasn't necessarily avoided, but rather considered relative to the return and bear the risk intelligently. Rather than avoiding the risk, the mentality started to change in the investors community on, I'm willing to take the risk as long as the returns are proportional. Okay. So that gave rise to a lot of new instruments, distressed debt, mortgage-backed securities, structured credit, private lending, so on and so forth. Private lending, very risky. But if you are willing to pay me 15%, yeah, I'll consider that risk. Yes, yes, Mike Milken. Thank you. He started I guess he popularized the whole concept of junk bonds. This is what the high yield bonds were. Basically, those are junk bonds. Now, the junk bonds are very acceptable way of investing, right? You have even you have an ETF, HYG, which is basically a collection of high yield bonds, collection of junk bonds. Those junk bonds are not junk investments anymore. So instead of being, I want to avoid risk, I'll take the risk as long as I'm a good risk to return ratios. So that was a sea change number one that happened in the investing community. Sea change number two, of course, was that we still talk today is Volcker controlling the inflation, and his action ushered in a declining interest rate environment that prevailed for later on after about 4 years, right? So Volcker successfully brought down the inflation and kept which allowed the Fed to reduce the funds rate to high single digits, which kept it till 80s, and then became to mid-single during 90s, and then 2000 we saw the Fed funds rate going almost to 0%. So the declining interest rate was a second big change, and that we have seen happening for last 30 years. Now he talks about the sea change number three, which says is happening now is, and I have a lot more details on this one. This was just a background, and we'll get into details of what is Howard's thinking in terms of the future, in the near future. All right, so it will be a little long read, but let's go through it. Everyone knows how little I think of macro forecast, but a number of clients have asked about my views regarding future interest rates. I know everyone have the same questions. Thus, I'll provide a brief overview. In my views, the buyers who have driven S&P 500 recent 10% rally from October low have been motivated by their beliefs that inflation is easing. This is what we talked about last week. Maybe we think the inflation is not going to go as high as what we thought earlier. Number two, the Fed will soon pivot. Number three, the interest rates will return to lower levels. I mean, that's the whole tailwind would be behind this. The market would be, Fed is going to pivot, keep the interest rate lower. Fourth, the recession will be averted or it will be modest. That's what we're calling as a soft landing. Right? This whole week, the narrative was probably we'll get a soft landing. And fifth, the economy and markets will return to their halcyon days. And if you look at the market, let's go back to our market. SPY is up 5% for just this week, from 350 to now 390, almost 10% in last few months. In contrast, this is what Howard says he thinks. The underlying causes of today's inflation will probably abate because we know it was because of the supply chain constraints. With now China economy opening up, maybe those reasons will abate. While some readings have been encouraging, the labor market is still very tight. When I say labor market is tight, we're not talking about tech labor. We're talking about a lot of services. Jolt's report tells us globalization is slowing or reversing. This we generally don't see much being talked about. Is because of reversal of globalization, if we are doing more and more of onshoring, doing a lot more manufacturing or returning a lot more jobs back to US, is going to be inexpensive. Right? Last 40 years, China was a big contributor for why the inflation was down. We could import everything from China. But now if you are going back and looking at, no, I don't want the cheapest good, but I want a surety that the goods will be there when I need it. And that's where we're seeing companies looking at more locations, which are probably not the cheapest ones, right? Moving out of China. Some are moving closer to home. Some are bringing jobs back to US. Some are looking at other areas like India, Vietnam, and all that stuff. Before declaring victory on inflation, the Fed will need to be convinced not only that inflation has settled near 2% target, but the inflationary psychology has been extinguished. Inflation is a self-fulfilling prophecy. If we have the narrative that the inflation will continue to go higher, our behavior will change to fuel the inflation. Right? If I know things gonna become expensive, I'm gonna go out and buy it right now, which will drive up the demand and which will in fact make inflation go higher. So not just the numbers, but the psychology is also important. Right? To accomplish this, the Fed will likely want to see a positive real Fed fund rate, which is not, right now it's not even there. Right now, the real Fed fund rate is at negative 2.2%. Thus, while Fed appears likely to slow the pace of interest rate increases, okay, there are oxymoron words in here, slow the pace of interest rate increases. So it's still going to increase, but maybe at a slower pace. It is unlikely to return to stimulative policies anytime soon. Fed has to maintain the credibility. They lost credibility in 2022 because they thought inflation is transitory. They don't want to lose the credibility again by becoming stimulative too soon. Fed faces question of what to do about its balance sheet, which grew from $4 trillion to $9 trillion. Allowing its holdings of bonds to mature and roll off would withdraw significant liquidity from economy, restricting growth. So rather than be in a stimulative posture, one might imagine Fed would prefer to normally maintain a neutral interest rate, which is defined as neither stimulative nor restrictive. Last summer, that were estimated at 2.5%, right? Neutral rate. Don't want to stimulate the economy, but don't want to kill the economy. Similarly, although most of us believe the free market is the best allocator of economic resources, we haven't had a free market in well over a decade. We only got to know when Fed starts to withdraw the liquidity or increase the rates that, oh, the market is not free. Right? It was Fed which was playing a big role in capital allocation. There must be risk associated with Fed keeping interest rates stimulated on a long-term basis. Arguably, we have seen most recently that doing so can bring on inflation. This is what we are going through right now. The Fed would probably like to see a normal interest rates high enough to provide it with a room to cut if we need to stimulate. I heard multiple times on CNBC the same stuff. And the people who came into business world after 2008, which is after the GFC, or veteran investors with short memories might think of today's interest rates as elevated. Oh, 4% is high. There were times when the mortgage were 16%, but they are not in the longer sweep of history, meaning there's no obvious reason why they should be lower. Yeah, so 4% is not high interest rate if you go back in history. That's it. These are the reasons why I believe the base interest rate over the next several years will be more likely to average 2 to 4% and not from 0 to 2%. So we have gone from a low return world of 2009 to 21 to a full return world, which is right now wherein Fed rates are higher, we can get some decent return. Investors can now potentially get solid returns from credit instruments, meaning they no longer have to rely on riskier instruments to achieve overall returns. So lenders and bargain hunters face much better prospects in this change environment than they faced in 2021. And more importantly, if you grant that the environment is and may continue to be very different from than it was for 13 years, and most of the last 40 years, it should follow that investment strategies that worked best over those periods may not be the one that would outperform in the years ahead. And that is the sea change number 3 that it refers to. The things have changed. 2%, we're saying we'll go back to 2%. That may not be the new norm. Maybe 4% is going to be the new norm. So the strategies that worked when 2% was the norm may not work. Maybe we'll go back to a higher interest rate as a new normal. That's a sea change number 3. I found it very fascinating. If you want to get into the full details of it, I shared the link. Go ahead. But his memos are good. If you want to be just to give you an overall idea, and sometimes it's great to read from or listen to the people who have been in this industry for 40 years, 50 years, right? History doesn't repeat, but it rhymes. The best way to know what's coming in future when it comes to markets is go back and see how market behaved in the past. Market generally tend to behave the same way. So thought I'll share that in here. All right, I see a few comments. Jay says Michael Milken is a philanthropist, chair of Milken Institute. He was a junk bond king. Was granted full pardon by president in 2020. Do you think Wall Street is counting on 25 BPS hike on 1st Feb? Yes, I think that's what the street is pricing in, saying we will now have only 25 basis points. And rates may go down second of 2023. I don't think we have at least I have not read, or maybe I don't recall, but I think that the rate going down probably will be cutting of the rate will be later in 2023. I mean, not immediately in the second half. It could be, let's say, of course, technically second half, but maybe in a Q4 or 2024. But things could change. All those are still guesses, walls. But on a Feb 1, I think 25 basis points is priced in. James says inflation will stabilize at a new rate of 4%. Yeah, I mean, that's what at least Howard is saying. Free market being free is only, markets being free is only an illusion. Yeah, a lot of investors have learned now that the markets are not really free. All right. Any other thing? Anything else that caught your eye? Otherwise, what? We are 45 minutes, and we'll spend this 45 minutes in next two topics. One is go through the ServiceNow as a do a little deep dive in ServiceNow, and also we'll spend 5 minutes on talking about zero DTE options, which is now becoming, I mean, a lot of investors are now loving the zero DTE options. James, what's the projection of where the markets will end up this year? I have no idea. Not really. I mean, I don't believe in these projections, and I don't work according to that projections. Now, depending on who you follow, if you talk about, was it Morgan Stanley's? Forgot the name of that analyst. Different analysts have different predictions. Predictions vary. General, I think if you look at a common, I think most of them are saying, and again, they are saying they don't have a crystal ball, saying the market will end up higher, but before it go there, it will go lower, let's say to 3,600 to 3,500 before it goes higher. That's what I see a lot of analysts talking about, that given the earnings will decrease, recession will be there. So again, these are the analysts talking about. So we would have, market would break more, market will see weakness, another 10%, 15% before it continues its upward trajectory. Now, when that bottom will come in, no one knows. Some are saying maybe it's only in the second half of the year we will see market going high, right? But today, I mean, we've already seen market up 5% in last 3 weeks. So it's all guesses, and some part of, given the infinite amount of time, everyone's guess will come true. So yeah, I don't stay in the market based on what the projection in the near term would be, because 50% of the time those will turn out to be wrong. So it's a coin flip. But this is what the market is. This is what the financial pundits are talking about. I've heard that it might end up at 5,000. I think it was what, Bank of America, or may not be Bank of America. Some other Wall Street firm gave a target around between 4,500 to 5,000. But the path will be treacherous. It will could go to 3,500, 3,600 before it goes there. Who knows? Asif says, market will follow the trajectory it has been following. Yes. Anyway, so let's talk about zero DTE options. Have anyone tried zero DTE options? So what does zero DTE even mean? Zero DTE means 0 days to expiration. Means the options are going to expire today. It means you open that option today and it's going to expire today. When you're opening it, it's a 0 days to expire. It's not that it's going to expire tomorrow. It's today itself is going to expire. Now there are if you really look into there have been a lot of options, especially on the indices that, okay, now they have every day, right? So prior to these, those zero DTE options have been introduced by CBOE in 2022. So prior to that, we have had these weekly options, as you can see here, it says 23rd Jan, 25th Jan, 27th Jan. Right? So these have been around for some time. If you look at a weekly, so weeklies expanding on Monday, Friday, and Wednesday have been around for many years. What CBOE did in 2022 is they added Tuesday weeklies also. And then in May, they added Thursday weeklies. So now, especially on the indices, you have these options that expire on everyday basis. So if I look at SPX, you have 23rd, 24th, 25th, 27th, 26th, 27th, 30th, 31st, 1st, 2nd. Everyday basis, you have options that will expire. And this has now, and we see a lot more interest after CBOE has introduced these additional 2 days, a lot of interest in these zero DTE options. James says, got burnt many times with zero DTE. Zero DTE is a coin flip. It's a binary option. It's very closer to binary options because you don't have any, there is no wall crush that you can get or wall expansion you can get. So volatility, the impact of volatility is almost negated. There is not much of a time value left. So you can't, so your Vega Greek doesn't help. Not much of a time value because there is no time in this option when you open the option, when you close the option. So there is no theta decay that you can talk about. So theta is gone. Only Greek that work here is gamma, right? It's just one last day option, right? So we got a lot of these options. Why? But why traders start to like the zero DTE? Because you don't have to carry any positions overnight. This will expire today. Whatever the pain or the loss, the pain, it will be done with today. You don't have to think about your position overnight. Whatever happened, it will be over today. You don't have to worry about, maybe in Asian market, Chinese government did something, or maybe something had happened overnight and tomorrow morning the markets will go, could move a lot against your positions. Don't have to worry about any of those things because your options will expire, tonight. So that has led many investors or speculators, I would say, to take some quick bets for that one particular day, and shows up in the stats. Right? In 2021, overall in a year, there were 247 million weekly contracts. In 2022, we had almost 5 million every week. That's a huge, 2022, after these new expirations were introduced, it's like a 5 million every week. Right? End of year 2022, we had 715 million contracts traded zero DTE, and the zero DTE increased like 83%. Now talking about Jan, and this is the start of Jan 18th, there are 2 million contracts traded almost on daily basis, which are zero DTE contracts. Out of 20 most active contracts in SPX, 19 are expiring today. 19 out of 20. And 36 out of top 40 are expiring today. So, I don't think it's only retail investors, probably and SPX is a big instrument. It is probably the most liquid, but it's a high notional value instrument. One tick is, the index is what, $3,972, right? One unit. So it's this is such a big product like NDX, SPX, IUT. Lot of institutional investors are involved. You can move a lot more money, allocate a lot more money through these big instruments. So the one thing that started maybe as with the retail, with the amount of volume that we are seeing, it looks like a lot of institutional investors are getting in. And like since 2022, we have seen this huge surge in the volume. Now, as you would know, in 2022, I started, I'd never dealt with SPX prior to that. I used to do only SPY. But in 2022, I thought to be more tax efficient, and you get the Section 1256 benefit. I started doing a lot more on SPX and the indices. But now I'm thinking of there is a completely new players. There is a zero DTE, and everyone is trying to play around to take a bet on one particular day. I don't want to get caught into all that stuff. Maybe I'm thinking, should I continue on SPX, or maybe I should go back to SPY? But something to be aware of. This is something which I never paid attention to, zero DTE. I never knew that the volume is so big. And when you're trading such huge number of contracts, sometimes it could just get detached from the reality of the market, just because so many contracts are expiring on that particular day, right? So for that moment, it could actually get detached. So that's what making me think, should I continue to use SPX? Because I'm using SPX for an entirely different reason. I use it for my hedging positions, whereas a lot of these players who are trying to use those zero DTE contracts are maybe just taking daily bets on it. So, and it could move the SPX in a direction which is not entirely defined by what we're seeing in the market. So, but a new thing which I learned around was this whole zero DTE. So, like I said, what to be aware of? Gamma is the only Greek that you need to be aware of. And if you do not understand what gamma is, I guess there is no business for doing zero DTE. Not gonna get any much help from the volatility. Not gonna get any help from theta. Only thing that's gonna help here is gamma, because it expires today. The gamma is huge. As you get closer to expiration, the gamma in your option position start to increase, and then it's gonna, all the movement will come out from gamma. So it's more like a binary. You take a bet, say it's up, down. I mean, that's what the binary trades are. So for me, it's just like a coin flip. Or if you want to just take a hedge for just today and don't mind losing all your money, call it a hedge, or a I want to take a bet to hit it out of the park. Take my my gambling chip for the day. Sure. So, but yeah, looks like this is becoming more and more popular, and firms and the exchanges will find a way to make more and more money from us. Oh, you want to trade on these options on daily basis? Sure, we'll give it to you. So there we go. Now we have these SPX expiring on everyday basis. Okay. So that's a quick one on zero. Anyone have had more experience? I know James, sorry, got burnt with, but this is like a binary. It's a coin flip. It works. There is nothing much you can do to manage your positions when you're dealing with zero DTE. Right? On others, where you have a little more time, you can salvage your option positions. But when it comes to zero DTE, there's nothing much you can do. Bob says, I've heard it is better to trade futures than to trade zero DTE. I think that's probably comparing apples to oranges. Futures have got much bigger notional value. And I would say I still trade options, but not at the zero DTE. Asif says same dollar amount, though logged into the contracts. Oh, I think I missed the context behind this question. What is the percent of ITM versus OTM that are sold at zero DTE? I don't know if CBOE has published this data or not. Let's see, zero DTE. Let me just quickly Google for zero DTE stats on CBOE. CBOE zero. Let's see. Trading volume for December. Does it break it down? Total option volume of 3.4 billion. Index options, new annual record of 714 million in 20. Oh, this is what I was talking about. 715 million index. Correct. For the year, a record 558.4 million SPX options were traded. There we go. Average daily volume, and this is for December and full year. Average daily volume for SPX with 0 days increased 83%, which we talked about, and comprised a total 43% of overall volume of SPX. I don't think they've given any information on ITM or OTM. James, maybe better to buy Schwab if the transactions were zero DTE, it goes up. I mean, we have seen, okay, there could be a lot of other reasons. I won't consider this as the only reason to buy Schwab, but we should buy it if Schwab is also doing a lot of other stuff outside of just the transaction volume. The money that they make through transactions. Yeah, but something to keep in mind, new instruments are now available in the market and people are using it. I don't use it. I don't intend to use it. I think my shortest one right now, which I'm doing, is buy 2 weeks out and then manage it in the last week. So, which are mostly the hedge positions on SPX or ETFs. I mean, indices or the ETFs. All right, so that's around zero DTE options. Now we can go to ServiceNow. Before that, I'll sip some water. Anything else? Anything else that you saw something new? Some new company you tried? Anything you bought, sold, or any other question? Coinbase. Ooh. For whatever reason, crypto has been looking good. Then I guess maybe the Coinbase too. From 31 to 55, not bad, not bad. Right, so if we look at, let's see, they up 64% in this year. What more can you ask for? From the start of the year to now, it is up 64%. Is it too much too soon? Maybe right now, I think it's all riding the growth or what we are seeing on the crypto side. Let's see. Whoa. Oh, Bitcoin is up 23K now. Jeez. And this, so the whole bankruptcy of Genesis trading, it had just brushed it aside like it doesn't matter. It happens. Probably it is the last straw. I mean, we have seen so many bankruptcies. I thought maybe because if DCG goes under, that's going to be a big, I mean, that's one of the biggest player. It's an issuer of GBTC, and a lot of traditional investors, pension funds, a lot of investors have exposure to Bitcoin through GBTC. If DCG goes under, which is a parent company of Genesis Trading, which already filed bankruptcy on Friday. But looks like the market is like, well, whatever, I don't care. Genesis goes under, it's fine. We will live, we will survive. Oh, okay. Last year it was closer to 20,000, but looks like overnight it's up 8.6%. So that's the reason why these, 24 hours, it's up almost 8.6%. Last 7 days, it's up 16%. And that's why we are seeing coin making parabolic moves. Probably then all the other proxies, coin, MSTR, MicroStrategy, yeah, almost in 132 to 240. They're probably all riding the wave of the crypto wave that we are seeing now. Ethereum is up 15% in a week. But Coinbase has one big problem is if the retail interest, they don't make much money from institutional investors. If you go back and look at Coinbase's, I don't know, which was the last one, maybe previous quarter or quarter prior to that, when we looked at their earnings result, most of their revenue comes from the retail investors. The revenue that they get from their corporate customers or institutional customers, which is moving through the custody and all those solutions, is very less. So unless the retail customers get back into trading of these cryptocurrencies, not buying and holding, the market is going to be tough for coin. And if Fidelity had announced, their intention to allow for trading and all that for cryptocurrency, if Fidelity gets into it and makes it much cheaper, but to create some good app and all that stuff, then coin will have a tough time. But make hay while the sun shines. So far, so good. Well, we'll have to see how long does, with all these bankruptcies and all that stuff, lot more, especially on the crypto side, folks are, the narrative is don't try to trade in and out. Don't keep it on exchange, move it off the exchanges, because you don't know when the next exchange is gonna go bust, especially these centralized exchanges. If FTX has gone bust, now the eyes are on Binance, which is now the largest exchange. What if Binance goes bust? And not to scare you, but the practices on the Binance looks really, really shady. The books on the Binance, people can't get their head around it. And it is the largest crypto exchange, centralized crypto exchange. So, but we'll see what happens. To me, it looks like maybe Bitcoin, because the halving is coming in 2024, is that has generated interest. I know that new $4 billion long positions were opened, and maybe that's the reason. But in my perspective, guys, this is too much too soon. This whole first 3 weeks remind me of the first 3 weeks of like Jan 2022, wherein the markets were rah on the 3 weeks, and then later on everything corrected. Not just corrected, it went deep into red. I'm not saying that we'll get back deep into red again. May not, I don't know. But to me personally, I am trying to reduce my deltas a lot more. I'm like 15% up in 3 weeks, just doesn't make sense. So we'll have to, maybe I'll do some selling in a retirement account so that I don't have tax implications. We'll see. But for now, I feel this is too much too soon. Okay, ready. Any comments on CATL? I think this is a battery company out of China. I have never, yeah, see, isn't this Chinese battery company, CATL? Yes. No, but let's look at CATL. My Chinese exposure is, well, okay. This doesn't have it because it's a, is it not listed on US? It should be. Okay, third source, CATL. Is it even listed or is got delisted from here? ADR termination. Oh no, this I can't find it. Can't find it on Finviz, can't find it on Google. I knew that this CATL company is a battery company, but where do they trade on? Option, okay. All right, if I can't trade on this one, I'll probably, yeah. So I've not looked into this, but I was aware that this is one of the big battery companies, and not this one. Okay, which is, oh, that's Roblox. Okay, Roblox we'll talk later. Not this one. All right, I missed the document that we were going through. There we go. All right. Sorry, Roblox was just because they did their December update. So I was updating my document on what I saw on Roblox. Some good positive news. Okay, we're not going to talk about Roblox right now. We're going to talk about ServiceNow. Okay. So what is ServiceNow? First of all, any shareholders of ServiceNow? Direct shareholders, not through mutual funds. Anyone holds ServiceNow in portfolio? And the ticker is NOW. So it says bag holders. We shouldn't declare the end of the mess too soon. Bag holder means you already declared, okay, I'm done with that as of today. Let's say as of today. Who knows, a few years down the line, you may say, oh, great, it's good that I held on to it. Yeah, for right now, might look like a bag holder because, I mean, this share has gone a multiple place. Anyone else have now in their portfolio? Disclosure, I don't have any now shares in my portfolio. I used to have some in 2020, and then I think whenever I wanted to do some tax loss harvesting or maybe reduce delta, I don't know why did I sell now, but could have been only one of those two reasons. Maybe the tax loss harvesting, otherwise I generally won't have sold it. Right now I don't own any. Okay, all right, so let's talk about now, because I want to get back into now. All right, no, I mean, really is that I was looking at some of the companies, and I found that ServiceNow is been very resilient, both in terms of business as well as in terms of the stock. So I thought I'll do another look at it after almost 2 years to see what this company have done, go into the details of their business, their product, financials, and blah, blah, blah. So let's dive into it, spend another maybe 20 minutes on this, and that will be the last part of our session today. So let's talk about a big picture opportunity first of all. Why does this company even there? What is driving its existence? The overall, what we're looking at is we have seen a lot more technological innovation happening. That's a given, that's a table stakes. We see those innovations happening all around us, and more employees. And now ServiceNow is an enterprise software company, and it is SaaS based software company. Means providing their services through cloud and selling mostly to enterprises, large, medium enterprises. Now, the challenge that these enterprises have is, of course, there are a lot more tools coming onto place. It means employees want to use a lot more tools, which is great. They can be more productive in doing that. But the challenge that a lot of these then bring is you're integrating all of them, right? Not everyone, there are so many tools which do the individual work perfectly. But then if I'm a company, I need to build, I have an employees who know all those tools. We need to build the capability to integrate all these different tools. So what ServiceNow provide is a way to effectively integrate multiple technologies. So basically, it provides a platform for enterprises to build and convert their manual steps into an automated steps by creating digital workflows. So if I was filling up a form and then, raising, let's say, a ticket and doing third thing, now using ServiceNow, all those process could be automated and it reduces the manual work. So that's the main page. That is why this company is in existence. They help the employees to do their work better, faster, cheaper, right? We make the world work better for everyone, right? And this has changed. Earlier, it used to be work better for employees. Now for employees, they move to everyone. And there's a reason, which is now I find, because I've looked at it after 2 years, and now I find, okay, what they're now doing, they're expanding from adding more products. So now they're also changing how companies presenting itself to the investors, which is good, which I like. Right? You change your strategy, you change your overall, where you want to take the company to, and then you also change the messaging accordingly. So I found few words that have been changed in terms between what we had reviewed in 2020 and what is in now 2023. So what did they do? ServiceNow help digitize and unify organizations so they can find smarter, faster, better ways to make the work flow. Right? Overall, they have almost 7,400 global customers, including approximately 80% of Fortune 500. Now, we believe people should work the way they want to, so we build applications that help automate existing process and create efficient digital workflows, right? So is it a product? No. Is it a platform? Yes. So difference between platform and the product becomes a platform enables a lot of other products, or there are two things. Number one, it enables others products, or it is a suite of product, not just one product by itself. Like AWS, it's a huge platform. It enables a lot of other products from a lot of other companies. Salesforce it started as a product, then became a platform, because now there are other companies who can actually build solutions which integrate and run on Salesforce. Right? Similarly, now ServiceNow is a platform for for a fast-changing world. So secular tailwinds, right? Business model transformation. I don't have to talk much about it. We all know that the work is becoming more and more digital. Technology is accelerating. Enterprises are adopting more and more on the cloud front. They're moving to cloud. Talent and employee experience, higher retention for top employee experience companies. 750 million new apps will be built by 2025. Right? There are a lot of tools which allow you to create new apps. There are but then how do you integrate those new apps within your ecosystem? If I am a CIO, Chief Information Officer, now I have a problem. How do we integrate, make sure that those are not disparate tools working on their own silos, but can be integrated? That's where the ServiceNow comes in, right? Class of one achieving rule of 60 at scale. This is, I really like this one, because generally on the VC side, on the Silicon Valley, you would have heard called rule of 40. But they challenge themselves with the rule of 60, saying the revenue growth plus free cash flow margin will be more than 60%. Right? More than 40%, it's a good investable company as a thumb rule from a VC perspective. Right? Organic trajectory is unparalleled. So this company hasn't done too much of acquisitions. Too much bolt-on acquisitions. Mostly it has been growing organically. And we haven't seen, lot more companies like these growing through organically and not, doing some big acquisitions. What's their product? We talked about digital workflow, but how do they enable companies to implement digital workflow? Their product is called the Now platform. Basically, this is a platform which allows companies to create or automate a lot of the steps in their workflow. And that's why it's called digital workflow. You can automate a lot of stuff. And what kind of workflows do they support? Different flavors are, some could be technology workflows, right? In which you got some work to be done by your IT team. There are employee workflows, right? Onboarding of employee, adding them to their facilities system. Customer workflows, right? Customer service. Someone calls your customer service desk, or someone sends an email to whatever the customer service platform that you're using. Maybe you're using Zendesk, maybe you're using Freshdesk, whichever one. Creator workflows. This is where you can actually create your own workflows by integrating a lot of apps onto ServiceNow platform. So you could also call it as a platform of platform, because some of those products supplied by other companies itself or platforms, which can now be integrated onto ServiceNow platform. So largely their workflows are divided into these main 4 categories, right? Let's looking at the tech workflows. Basically the workflows that happens between you as an employee and your IT team that provides the service, right? My laptop is broken. How do I access this VPN? My VPN access has been disabled. Please grant me. I need to have access to this AWS cluster, right? Or a new employee joins and that need to be enabled and their accounts need to be created in Okta, things like that. Employee, okay. So what are looking at now? Oops. Yeah. Employee workflow overall, $14 billion of TAM, which employee workflow is mostly around when an employee joins, bringing them, onboarding them onto your HR system, making sure they get added onto your financial system for their payments, making sure they have get access to the company's intranet, get added to, let's say, your Slack channels, or get onboarded onto Slack and all that stuff. So that's they estimate around $14 billion of TAM. An example is, yeah, I could create a reservation. You can visit Tech Launch or anything that help their employees. Customer workflow, total addressable market around $51 billion. Right? Using these workflows, customer could empower employees to deliver frictionless customer experience. A customer is reaching out to you. Now, how you help that customer in a seamless manner. You can solve customer issues quickly and proactively. Right? And this is one big problem around the customer service is the system that you are given to, the system on which the customer logs a complaint. It could be they may be calling you through phone, they may be sending an email, they could be logging in a ticket onto the ticketing system that you are given. There are multiple channels, but then once that ticket is in there, you probably, as a customer service agent, you might need to look into 5 other systems to figure out, to get an answer to help the customer. How do you integrate all of that? That's where the whole customer workflows would be. Technology workflows, customer workflow. For example, this is a example of a case. Some customer is raising or doing a fraud dispute for a car that customer feels the car has been tampered with. Another is, this is a ServiceNow's customer doing a workflow optimization, right? Creator workflow. You can actually build your own apps by combining, off-the-shelf apps, by integrating multiple apps and creating your own custom workflow. So what this helps is help the developers to create applications at a faster pace. So which means it will result in basically more productive workflows, right? Let me just zoom in, see if we can get a little better view. Yeah, for example, you want to create some automated flow. You want to start with creating an own workflow for plant maintenance or emergency response, so on and so forth. Okay, one code base, one architecture, one platform. So ServiceNow actually started in cloud. So there are other products, other companies who also do few of these things very efficiently. But they all started, majority of them started with their platform, which means you have a system that is sitting in customer's environment. But ServiceNow started as a cloud native. So you don't have to re-architect everything. You start with the right architecture itself, which enables them to have one code base and one more thing, which is the new one. This wasn't there in 2020 when we reviewed it. Now they're introducing ERP workflows. Makes sense. You started with your foothold into an IT, sold your system to an IT manager, and helped them to reduce the IT workload by automating, service tickets, how you service your employees and all that. Now they're expanding beyond just those core workflows to saying we can actually become an overall enterprise resource planning. ERP stands for enterprise resource planning. The most famous software company in this space had been SAP. Some part of a time, it used to be the largest software company in Europe, right? And of course, then there is Oracle is in this. Microsoft has their own product. I think Microsoft Dynamics, which does the ERP. Now ServiceNow is moving into, again, ERP is nothing but it's a series of steps threaded together and created a workflow which cut across the organization, right? For procure, looks like they're coming with the procurement, supply chain management, and accounts payable. So that's a new thing that they're bringing in now, right? I'll skip this one. Let's just talk about an example of prior to ServiceNow, how an employee onboarding process would have worked, and after ServiceNow, how it works now, which is many of those stuffs are just automated. From a customer perspective, they have 7,400 global customers, including 80% of Fortune 500. So marquee customers. More important is 1,500 customers are spending $1 million or more. 100 customers are spending more than $10 million per year. So they have a huge customer base, but out of that, this is like 20% of those customers pay more than $1 million. Right. Also, the renewal rates are pretty high, 98% to 99%. In past 5 quarters. When I say past 5 quarters means, of course, the results are not out for the recent one, but now this we are looking for is a Q3 of 2022. So it means any of the spending cuts, etc., that have happened in Q3, sure, it impacted, but still 98 to 99% of the customers still stayed and renewed. So their strength, they are born native to cloud, means you don't have to put a band-aid on your existing technology to make it work in the cloud. You basically just started working, as when you started working, you were born in the cloud. So their focus is on platform approach, which is what I like. It's like an app store is a platform. So there are hundreds of developers that are developing applications for ServiceNow. Just like developers developing for App Store, just like there are companies that develop applications to work on top of Salesforce. Right? A renewal rate we already talked about. A fast installation because it's on cloud. So from an end customer point of view, if I am buying ServiceNow platform, my time to value, again, we measure onboarding TTV, is much quicker, or time to value is much faster because it is in cloud and I don't have to worry about installing it in my place and managing it. And market opportunity is good because of the digital transformation that we are seeing. Right. Now let's look at some of the financials. It's a $75 billion company. It's not even $100 billion. They have $3.96 billion of in cash, so decent amount of cash. Revenue in 2020, last 12 months revenue is around $7 billion. And it is profitable. Not by huge, but it is profitable. It's not one of those companies that is burning money and not make, and this is GAAP profitable, not pure, this the conjured up numbers. These are GAAP profitable, not adjustable profitable. So sales have been growing 30% year over year, and gross margin stayed between 75 to 80%. We'll look at this, some of the financials a little more. Subscription revenue grew 22%, RPO 18%. Let's look at year over year growth. That will give much better picture. So almost closer to 30%. If you look at this blue line, is 30% year over year growth in terms of revenue. That subscription revenue, which is what we want to focus on. It's a SaaS-based company. Subscription revenue is all that matters. More important is if you look at the customer cohort, which tells us the customers that have stayed with ServiceNow, have they grown their the dollar amount that they spend with ServiceNow. Right? Retaining customer is great. Getting more from that customer isn't better than that. So if you look at, let's say, go back the customers that were with them, hold on, this is yeah, that were with them in 2010. So this is annual growth or ACV. ACV is your annual customer value. Means this includes subscription plus any professional services work. So the customer that have signed up with them on, again, this is not one customer, but overall of the, put all those customers who signed up with them in 2010, 10, 12 years ago. They have grown their overall value, annual value by more than 189%. Right? Similarly, customers who have been with them for 8 years, let's say 2014, have grown the amount of money that is spent with them by 88%. Right? Not only just retaining, but growing the customer that has stayed with them. This talks about expansion of customer relationship. Again, this is shows the number of customers with $1 million ACV is growing from Q3 of 2020, more than almost 50% growth for in Q3 of 2022. So number of customers that are paying more than $1 million to ServiceNow has grown over 50% in last 2 years. So like I can skip that. Renewal rate between 98 to 99%. Headcount, yeah, they have been growing, but little, I would say, a little sensibly. Still, majority is between the sales and marketing and R&D. What I don't like in this is their S&M is bigger than their R&D. At some point of time, I think probably it will. I would rather like to see spending more on the R&D side and then on S&M. GAAP operating of free cash flow margins, that looks okay. Let's talk about leadership. There was some question around CEOs. CEO Slootman switched from Now to Snow back in 2017. Yes. But then they, in 2019, they got Bill McDermott. And Bill McDermott, he was an ex-CEO of SAP. So he knows a thing or two about selling to enterprise customers. Right? He's got a great products. He's a great, he's a good salesperson. And he's been expanding the scope of ServiceNow business. And that is why 2 years ago, I mean, he joined in 2019. 2 years ago, when we reviewed, there was no concept of ERP, but now they're getting into ERP as well. what I also like is he still get bulk of his compensation through share-based incentives, which means it is aligned with my incentives. So almost 160 million stock and option in 2021. Do they have a competition? I mean, Salesforce, yeah. Amazon, AWS, Salesforce, Workday, some could consider, but I think one of the big competition will be their in-house teams, right? Most of the time you would see customers will have their own IT team, which will be stitching together the different applications, right? And then someone had coded that years ago. Now they don't want to make any change because no one knows what logic has gone into it. So yeah, in-house IT team is a competition. Others, I see this as Oracle, because Oracle is now moving very aggressively into cloud, and Oracle generally has, from a sales perspective, they are also deep into many of the enterprise customers because everyone had been using Oracle database. What are the risks? Tough macroeconomic conditions, right? If it's going to be a recession, if companies have to cut down on their IT spend, it will impact a lot of companies, including ServiceNow. Right? So far, they haven't taken any big acquisition, but Bill McDermott, the CEO, he's known to be not afraid of, taking a big bite. But so far, we haven't seen that. Of course, this is a generic one. Other risk which I see is, could it be acquired by a bigger player? Right. Microsoft, I don't know how much Microsoft generate from its 360 Dynamics, but if this ServiceNow become big, could Microsoft acquire it? If my bigger company acquires it, then then we don't get, as an investor, then we don't get to enjoy the same growth that we could have had if it could have been a standalone company. Right? The last one is that this market seems to be attractive. They are still growing at least as of Q3 of 2022, they've been growing at 30% clip rate. Given the tough conditions in 2022, that was still impressive. So it has shown that the market is good. So it could attract a lot more players in this space. That basically become victims of its own success. Many of the time you will see big companies waiting on the sidelines to see, I don't know if the market is big enough. Let someone else test it out and prove it. And then you see, okay, someone has tried and proven that the market is good enough, you can make some good money and it's growing. Then we could see bigger players jumping onto it. From valuation perspective, if you look at a standard valuation, to me, P/E is still higher, 400. But it's doing a lot of a growth. So I will look at P/E. If I'm looking at price by sales, it's 1251. Even though still higher, 1251 is still high for a company. But go back to last week where we looked at a lot of private deals that had happened. I think there was a slide from Morgan Stanley or some other Wall Street bank, where there's a lot of private equity firms that have now gotten into buying a lot of software companies, and they're paying close to 11 PS. Price to sales was approximately 11. So the idea was that maybe 11 could be the floor for these SaaS, and I think those were all SaaS deals, if I recall correctly. 11 could be the floor for good SaaS companies. So from that perspective, I don't see 12.51 to be being hugely as overvalued. Now, of course, right now is a situation because stock has corrected a lot. At some part of a time, it was like $620. And it was almost cut into half to 337, which looks to be last 52-week low, and now it's back to 440. Let me see what's their 3 years max. Oh, they were at some point in time they actually crossed 700. Yeah, so they lost 40%. Even now also, it is down, let's say 30% or 40%. It's still down 40% from its all-time high. So that the correction in the valuation has happened. Still, it is 12 times sales, higher from a general perspective. But looking at a lot of the deals that have happened and the growth, if you can still grow 30%, not overly expensive. Last thing you need to be aware of is they have earnings on Jan 25th. Anything could happen after earnings. We don't know. Stock goes up, down. So if you can't go through that volatility, again, just be aware of it. Then maybe do whatever you want to do after Jan 25th. Lastly, they are not opportunity constrained. They're looking to expand into new markets, growing their partner ecosystems by adding more partners like Microsoft, Accenture. And so far, we have seen some industries solution ERP workflows. Maybe they could come and move into observability. Once you have the hooks into various other systems, now you can find out a move into area in wherein you can give a little more insight into what's going wrong where. Who knows? So again, their opportunity, which is immense. They started as a company to help the IT department, moved over to HR side of the world. Now they're moving into ERP, which could be supply chain. At least they talked about 3 areas: supply chain. There are 2 others which they had mentioned, and could move into observability. Right. I think that's it on ServiceNow. So this is, I don't have any positions right now. Again, it's not a financial advice, but I can add 1 or 2 tickers. This is one of the tickers. Which is on my radar. So I thought I'll go through it to see what has changed. What have they done in last 2 years? So better than buying at 700. 440 looks to be better than that, but a few weeks ago it was 350. So is it too much too soon? Who knows? So, and earnings are coming up. So how much? Okay, I missed that. Okay, I'll see. So I'm paying $75,000 for a bits, generating $2 per year profit. Yeah, their earnings are no, I'm not paying that much. The price to earnings is what, around 400. It's not cheap when you're looking for a profit perspective. Okay, SBC. No, I did not. So let's look at their report. ServiceNow, investor relations. Let's pick up quarterly results, the latest one. I want to get where is the filings? There we go. Okay, so let's look at their SBC and their cash flows. So there, it's got $1 billion of stock-based compensation. Okay, and net cash flow for operating activity is $1.5 billion. Yeah, so not, I mean, it's not that all of their cash is coming from SBC. It is a big part, but not entirely like you see in some of the other companies. Did you want to see anything else? Hold on, might be Finviz will have a more comparison of it, right? Now, cash flow. Oh, okay. They don't break it down and show the SBC in here. Yeah, I mean, so if you get net 175, so 175 million was a net income. Stock base was 1038. Depreciation, amortization. This is a deferred commissions. Now, even if we do the stock-based compensation, I mean, still they have a $500 million of this. Okay, see, how do you buy T-bill on exchanges? You'll have to go through a broker. So if you log into your broker and go and look for bonds and CDs, so they'll have a section called bonds and CDs. From there, you can find out and place an order over there. Or the other way is to go to Treasury Direct. So if you want to buy Treasury bonds, you can go through a broker website. Let me see. Okay, so all right, for example, if you have TD Ameritrade, on TD Ameritrade, once you log into TD Ameritrade, you can come to trade and say bonds and CDs. It will bring you here. Here you see US Treasuries, and then you can click on US Treasuries. Oh, come on. On the 3-year, it will tell you these are the ones you can buy. I mean, you can pick up whichever you want to. So you can buy through your broker. I saw T-bill about 4%, but no 5-year lock, no state tax. Yeah, there are notes of 10 years also, right? Let's go Treasury Direct. Yes, there are no state taxes. So these are there is, what was it? There is federal tax, but no state tax. There is one tax is there. Yeah. So you have a 2-year, 5-year, 7-year bonds coming up. So if you're interested, there are these bonds on Treasury Direct. Now, what could happen is I'm not sure if brokers, because I haven't looked into my brokerage firm. I want to buy 17-week, and I don't know if all the brokers have all the weeks available or not. I have to do more research, but for me, I just kept it simple. I just come to Treasury Direct. I open an account on Treasury Direct and I'd buy directly from Treasury Direct. But yeah, you could buy 5-year. And if you look at where the recent auction results, oh, where did that go? Yeah, 17-week was like 4.61. I think the one which I got latest is at 4.8%. 17-week, and that was on 17th on Tuesday. And then you got 26-week. If you look at the notes, yeah, you got 10-year note. The most recent one was in mid of December, which was around 4.125. So yeah, there are ways you can do it on your broker or you can do it here. How about I-bonds? I-bonds are covered in some of previous sessions. You could buy I-bonds. I forgot what were the tax implications. I think again, some of them was tax-free, but be aware of the lockup periods on I-bonds and the penalty for early withdrawal, and the fact that you can't even withdraw anything for next 1 year. Be comfortable with that if you want to do I-bonds. But 2 is on I-bonds right now. The interest rate is, I think, still attractive, 6.82% for the next 6 months. We don't know what the interest rate would be later on. Right? If inflation keep coming down, they may, they'll bring down the yield that you get on I-bonds. So that's the reason I didn't pick much of I-bonds. I just did one to understand and experiment, but I didn't want to lock it for 1 year. Cool. All right. I guess that's it we have for today. So we looked at ServiceNow. We looked at Howard Marks and 0 DTEs. Hopefully it helped you in some way if you're looking to open a position or anything. But I'm still active. I'm hopeful about the market. I mean, this week it was a pleasant surprise. For now, I'm feeling a little jittery, but because it's, to me, I think it's just a run up too much in first 3 weeks. Give me a, PTSD of Jan 2022. So we'll see. All right. Goodbye, everyone. And we'll talk again next week. Thank you for time. Oh, there was one question. Hold on. There's a chat. Bob says to take a look at financial seasonality trades. Yeah, I mean, when I move into the mode where I can spend a lot more time on managing investments, maybe at that point of a time. But right now, mine is mostly buy good companies and find a way to stick to them and to hold to them. So there's, before I finish, there is an interesting tweet, because buying at the right price is not the end of game, right? That's just a one half part of it. And it was like yesterday night, I saw a tweet, and that person has a lot more followers. It's on, few hundreds of thousand followers. And I've seen in some of his Twitter space, more than 1,000 people will join in. And he was talking about how he nailed Google at 85. He bought some positions on 85 and sold a covered call, right? And it's like, I do want me to publish more of that. I just responded, I'm like, that's buying at the bottom is great, but you sold your covered call and you got out after 2% return on investment, right? Someone who didn't buy at 85 at the bottom, but bought at 90 and got out today at 98, probably made more money. So it's a buying, and that's why it's exactly find a best price and all that. I find that a lot more things that go in being a good investor. So for now, I'm just focused on how do I stay invested, and how do I find good companies to invest in, and then don't sell it unless there is a very specific reason like tax loss, or hey, the reason for which I invested has changed. Yeah, stock has gone down 20%. That's fine. But thank you for this. Until I'll see if they have if they give a lot more data around the company, I'll be interested on this one. Cool. All right, guys, let's stop right here, and we'll talk again next week. Thank you.